Hi, everybody. This is the investing teacher, high school science teacher, teaching others how to invest. This video, I want to go over what the strangle strategy is. It's a strategy I've been using pretty frequently recently on the Tasty Trade platform, where you can do this with futures and you can also do this with individual stocks. What I like about this strategy is it's similar to an iron condor, where you'd be receiving credit on one side no matter what. And it's a very flexible strategy. You could actually choose your deltas, just like selling a naked put, selling a naked call in different directions. If you are more bullish or bearish, you could pick appropriate strikes for it, and it gets a good amount of premium, especially in this high IV environment. So let's get right to it. All right, so this is the profile of a short strangle. In a short strangle, you're essentially going to be selling a put and also selling a call, but we're not going to be making them into a spread. We're just going to simply sell the put, sell the call, and not buy any options. So there's really only two options involved selling in the puts and the call side. Now you can see in the return profile, let's say a stock's right at $100 a share, you'll be at max profit all the way to where your short strike is. So let's say you sell a put at 95, you can make profit all the way here. And also, if you sell a call at 105, you'd be receiving the max profit as well. What's interesting about this strategy is as one side might start to get a little bit challenged, the other side would hit your max profit a little bit quicker. And we'll see that on the Analyze tab shortly on Thinkorswim. If you happen to go beyond this side, let's say we're going to like a 110 or so, then you would be assigned on the contract. If you're selling a call, then you would actually be short the contract, especially if it's like a futures contract. If you sell a put and it goes below, let's say the 95 at like 90, then you'd be assigned one contract or assigned 100 shares. And you could always wheel these as well. So let's say it goes to 90, you could sell covered calls against it because you own the shares or contract. And you could also make money on the return back. So if we look at the Thinkorswim platform here, do this with KO, for instance, Coca-Cola. Right now it's at 55.03. Go around 43 days out. If you wanted to make a pretty reasonable strangle, you could go around a 0.1 delta. So you would be selling the 45 put, and then you would want to be also selling the 62.5 call. You click Control click, you'll get both of those together, and then you could go to the Analyze tab, and you're going to see the risk profile. So this is the purple line is where we are today. Obviously, if it makes a big jump today, it would show a little bit of a loss. But as you go out later in expiration, then you're going to be getting closer to that green bar where you're going to be at a much wider profit zone. And you can make up to $52 in this case if it goes anywhere in these bands. Now, the way that I like to play these strangles is to go really low deltas on these. So if I'm going with MES in the futures, I'll tend to go around 0.03 to 0.05 delta on both the put side and the call side. If you're a little bit more bullish, you could decide to go a little bit on the lower delta in the call side, but maybe make the put side a little bit higher. You could also do the opposite. If you're more bearish, you could go really low delta on the put side, but then go higher delta on the call side as well. So all these are different strategies that you could use in order to make pretty profitable trades. All right, so again, I'm the investing teacher, high school science teacher, teaching others how to invest. If you're interested in seeing every single strangle I do, you can click on the description down below at thetatraders.com. And you could also leave a comment down below if you have any questions. Here to help you guys. So again, happy trading and good luck out there.